Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Good morning, everybody. Welcome to our coffee break. We have a very timely topic this morning, and the topic is best places for the now bucket amid the dropping interest rates. It's a very timely and it's going to be a very interesting discussion from our two guest baristas. The first one is Greg Hammer. He needs no introduction. He's the president and CEO of Hammer Financial Group and a mentor at C2P. And our second barista that I'm really excited about too is Charlie Ehrenfried, and he's the owner and wealth manager at Retirement Matters. Let's get the discussion going. Charlie, let's kick it off with you. Have you seen any questions or concerns from your clients on how their finances may be affected by the dropping interest rates? I've heard a few questions being asked of us as our support team here at PCA, but how about you from your clients?
Yeah, I wouldn't say I've gotten necessarily concerns from clients, but I think it's an opportunity for us as advisors to reiterate the importance of the bucket plan, because I run across a number of prospects and cases where clients were just overloaded in their cash accounts or their now buckets, especially these last couple of years, because if they could get 4 or 5% guaranteed, why not put all of their money in those strategies? But I think it's important to remind people of what that real rate of return looks like. And the reason they were getting 5% is because inflation has been as high as that in these last couple of years. And so they're really not growing their money still. They're just really parking it. And at the very best, they might be keeping up with inflation, but the reality is they're still probably losing purchasing power over the long run. So I think it's a great opportunity to reinforce the importance of the different buckets and make sure that you don't overload in any one particular bucket, because you're just transferring the different risks. And you might be reducing or eliminating market risk, but you're increasing inflation risk or reinvestment risk. So I think it's an opportunity. I also try to spin it wherever the positives are with the clients and say, listen, even though rates are dropping, that's typically a sign that inflation is easing as well. And so hopefully that helps everybody's pocketbooks.
When you have those conversations with your clients, are there any particular products that you discuss within the no bucket in particular, in light of how interest rates are panning out? I know personally, I've talked to people about laddering CDs within the now bucket, maybe using some T-bills or treasuries within the now bucket. What about you? What type of conversations are you having with your clients?
Yeah, I think the same. If they want to lock in a fixed rate for a short period of time, using CDs is fine. Money markets are still paying north of 4%. So there's an opportunity there. Obviously, that's going to be more of a variable rate. So those will probably come down as well. But they still maintain the liquidity features, unlike the CDs. I think it's finding that balance there. But I think just going back a step, and one of the things that I always tell my clients is cash flow is the heartbeat of retirement. And so we need to make sure as the advisor that we have a good pulse on their cash flow. And if we have a good understanding of what their cash flow is, if clients are operating out of a monthly surplus and their cash levels are increasing each and every month, each and every year, that now bucket just grows. It doesn't actually get spent down. We need to make sure that we have a good understanding of where their comfort level is with how much cash they should be holding on to. So I use a thermostat analogy, and I say everybody's got a certain comfort level with what they need to keep in cash. So when you log into your bank account and you see that balance, everybody's got that amount that just makes them feel good. It helps them sleep at night. But then if that level gets too high, then we start to get really comfortable, or we feel really good. And then spending can, perhaps get out of control. I know that happens in my own situation. If I see my cash levels get too high, I start finding ways to spend it. And that can, potentially cause issues with the overall plan. So making sure that where their comfort level is on that thermostat, but then reiterating the fact that when we exceed those levels, we need to make sure that money is being as productive as possible. And it might be shifting it out to one of either the soon or the later bucket.
Yeah, that makes total sense. That makes total sense. I like that analogy, the thermostat analogy. But let me bring Greg into the discussion a little bit. Greg, with interest rates dropping, and we've seen some wild fluctuations over the last month or so, and even before that, early in the summer when things started looking like the Fed is going to cut. What are some of the challenges that you and in your office are facing with maintaining liquidity and stability in the now bucket?
There's a couple of things that I like what Charlie had added. Now buckets are different for everybody. So let's start with that. Some people don't require a lot of money in the now bucket. So if they're in insignificant dollar amounts, I'm just going to tell them, look, we don't need to make money on everything. You having $30,000 in your emergency fund doesn't need to make 5% because we're not talking huge impact. So what Charlie was saying makes a ton of sense. If they're starting to get bigger amounts, then there's less of a challenge to look at laddering CDs or looking at some more liquid instruments that could be managed money because they want to maintain that liquidity. But it's no different than anywhere else. We don't have to have it like, oh, the washing machine broke. I got to go grab this money today. The roof's leaking, I got to fix the guy tomorrow. So it's really going to be determined by what they feel that requirement is in the cash bucket when we're talking to them. But I still am, right now, the CDs, myself personally, I got college coming up, right? My daughter's going to be in college. I'm not exactly sure. It's the first year. It's making me nervous with just how the logistics, where she's going to get approved. But at the end of the day, I don't know if I make a payment in the spring, do I make a payment in the summer, do I make a payment in the fall, but I'm still using 3-month CDs. Because I got a 4.7% 3-month CD for what I know I'm going to pay at some point. I just don't know the date, but I know it's not going to be 3 months. So it's just a matter of where you want to go into it, because really, if they're starting to look at bigger amounts, like Charlie's indicating, you really need to talk to them about, is this a now asset or is this going to be a soon bucket asset? Because if you start getting into these higher reserve amounts, to what he was saying, you're either going to start spending it, like we're human nature. I walk around with cash, it gets spent. I walk around without cash, I still survive the day. That's just how it works. So it's just that communication and talking philosophy about what do we want here, I think, is the most critical part in that interest rate environment. But I think the CDs and bank instruments, like the money markets, you could still get, they just got to do their research.
Have you seen, or have you talked to people? Have you changed your approach now that interest rates are on the way down and the Fed is certainly communicating to that effect? Have you changed your approach of how you talk up the now bucket? I know you mentioned ladder CDs and maybe high money market accounts, but do you see anything else? Have you recommended anything else besides that?
Yeah, I think you can really start talking conversation around short duration bonds now, right? Because you're looking at less risk in the bond arena with the falling interest rate environment than we were in the rising interest rate environment, where I didn't want any part of that. I didn't want any part of that even for the soon bucket, right? Because we knew that there was going to be devaluation in the bond market. But I think you could look at more actively managed bond platforms and still find it very attractive that we use in the soon bucket, because I don't feel there's inherently the same risk that there was a year and a half ago.
Yes, that is very true. That is very true. Have you guys used any annuities maybe to manage the now bucket? Or besides, I know annuities would have to have been several years into it and maybe exercise a 10% withdrawal provision. But I've seen some people lock in high interest rates on those multi-year guaranteed annuities and use some of that cash flow for the now bucket. Have you seen or have you thought about any of those strategies?
We've had things that have evolved there, right? So we have clients with long tenure. We have annuity contracts that are liquid, that have minimum guarantees that we utilize, the MIGAs. And those, if they become liquid, it lends to a different approach, right? So when we sit down and review with them, say, hey, we have access to this money now. There's less that we need to keep readily available because we can get at this money, but you still got to be cognitive of tax implications too. Because if I'm peeling off of an annuity there's going to be a tax implication because of the accrued interest. Remember, LIFO, right? We do have some of that will allow people, the philosophy we use is say, hey, our assumed bucket's a lot easier accessible. There's no timing with it. We have this, do we really need to keep this much in? I prefer to change the philosophy of their thinking around the money. Right? If we have a better accessible soon bucket, why do we need to keep so much money in the now bucket? As opposed to saying, let's make the soon bucket now money and now money soon money. We have better flexibility because we've evolved our plan. Let's look at putting more of this money to work for us and maybe even emphasize a later bucket.
Oh, yeah. Yeah, no, that makes total sense. And what about you, Charlie? Have you used anything else besides what we just talked about, the high yielding money markets and CDs?
I think to Greg's point, it just helps you remind them of what they have in the soon bucket. And a lot of times those two buckets can bleed into each other. And so even if somebody has a taxable investment account, a liquid investment account, they don't always view it as liquid because they're just afraid to sell, even though they can do unlike maybe an IRA with the 59.5 rule. But that's where we'll remind them, hey, we've got these annuities in your bucket plan. You've got the free withdrawal provision, regardless of what goes on in the market. We can take money out of those if we need to. But I always, again, to take a step back, just reminding the clients that where the bucket plan, how this fits in for them is money is nothing more than a tool to help our clients fund the life that they want to live. And so where the bucket plan comes in is it assigns a specific purpose for every dollar that they have. And obviously we use 3 different buckets for the different time frames, but those different buckets have different purposes. And the now bucket's purpose is not to grow their money. That's what the soon and the later bucket's for. So the now bucket's really just a storage place for any emergencies or unplanned expenses and any planned expenses, to Greg's point, with his child's tuition coming up. If there's known expenses on the horizon, we're going to park that money in the now bucket. But beyond that, we really don't want to be overfunding the now bucket because we just introduce different types of risks. And that's where we've got to then redirect the focus to making sure that we have the right amount in the soon bucket.
Yeah, the now bucket is supposed to be the lowest risk bucket, right? It's not supposed to be for anything relegated to risk taking. It's just any of the expenses that people have coming up in the very short term. And oftentimes, especially during the zero interest rate environment that we had back during the great financial crisis and for the subsequent years after, people were struggling for yield and they were hungry for yield, but there was nothing and nowhere to hide. And so what people did was they pushed the risk curve out. They took unnecessary risks with some of that now money and now bucket. And it's now we have options. And that's partially the reason why we have the call today and the coffee break today is because people have options. And whether it's going to be the CDs, whether it's going to be some of the strategies that you guys talked about, whether it's going to be the money markets, we have options. And it's those conversations, that education. And I know, Charlie, you have done a really great job educating your clients on. And how do you typically, when you explain the process, do you see any pushback on how you structure their portfolio within the bucket plan philosophy?
I bring up that thermostat and I first find out what's their comfort level. And even before that, we educate them on the sequence of returns, risk, and why we have to have a now bucket and soon bucket, and why we can't just have all of their money in the market. But then you ask them, what's your comfort level? And sometimes you'll get answers all across the board. Some people will say, oh, I don't need any money because I've got a home equity line of credit, an open line of credit on my house. It has a 0 balance, but if an emergency came up, I could just borrow against that. Other people, they need 6 figures in their bank account because that's just what helps them sleep at night. And so you just have to educate them on where the plan might lose some efficiencies. If we have too much, we just introduce, again, these other risks. And if we don't have enough, then we can run into problems too. But I'm not going to fight somebody over if I think they should have 50,000 and they want to have 60,000, right? fine, keep 60,000 and let's move on. But if somebody says, no, I need 600,000, then you got to take a step back and just educate them a little bit more on where this could hurt them in the long run.
The one thing that I have learned over the years is it all depends also on the yield curve. And we as advisors need to do a better job of finding opportunities within that, and especially when it has to do with the now bucket. And I think I saw a presentation earlier this year by Dimensional and some of their fixed income managers and how they find value along the curve. And keep in mind, for everybody here on that has joined us today, keep in mind that the yield curve is very inverted still in the very short durations. What that means is that you still have really good options for your now money, for your now bucket. And it's besides what we have talked today, some of the things that I have discussed with clients and advisors over the last few years is look at the floating rate ETFs, look at the floating rate funds. Those are some of the things that still work in this environment, because as a floating rate, even if it's a treasury floating rate ETF, the current yield is still better than anything that you're going to get over a 2 or 3 year period. So those are some of the opportunities that we still have, even though interest rates are coming down gradually towards the end of the year and early next year based on projections.
I would say is, as much as people want to try to get the maximum rate of return on their money, especially in as close to a risk-free environment that they can, they hate taxes even more. And so if somebody's sitting on a large pile of cash and you look at their tax return and that interest income is a rather large line item on their tax return, and you can show them how, if this isn't truly now bucket money and really should be shifted to the soon bucket or maybe even the later bucket, let's put it in a more tax advantageous vehicle, maybe a MIGA or a muni bond ladder or something like that, where we can shelter the taxes and bring your tax bill down. That usually, in my experience, trumps the seeking of the highest rate of return.
I love how you brought up taxes. That's fascinating.
Well, I think it's important to add too, and what Charlie's really indicating with this is the crux of it. Are they aware of a problem? Because the first step in any of this, they say, I want to make a higher return. Okay, what is the awareness around it? Why is it a problem? That problem might be that you're not positioning this money in the right bucket to create that return. And so that red flag philosophy is the awareness one, but the bigger part of it is, do you want to fix it? Because if you want to fix it, it's going to require you making a change. Whether you do it with me or somebody else, we're going to have to fundamentally change your approach, because having $600,000 in the money market, if you don't think it's a problem, great, but understand that's not going to function for what your concern is. So either you want to make the change to fix it or you don't. And that's the mental hurdle that you have to go through with them, right? Charlie, I use that language all the time. It's an asset positioning plan, right? That's the purpose of the bucket plan philosophy. It's about positioning assets for purpose. If our purpose is to make money, it shouldn't be positioned in the now bucket. That's not the right place for it. And so we have to create that epiphany within the client, all right? So here's the problem. You're trying to make a car carry dirt, right? You need a truck for that. What you're doing here and where you're positioning this money is not going to solve what your concern is. So do you understand that the problem here is we're not positioning this asset properly? Because if you're not aware of that problem, well, number one, we're not going to be able to fix it. And then the second part is, if you feel like this is what your objective or purpose of this asset is, the question I ask them directly is, do you want to fix it? Because ultimately, if you don't want to fix it, we're not going to solve anything. But if you truly want to fix it, it's going to require that you make a change. Whether you do it with me or somebody else, it's going to require you make a change. So do you want to fix it? Yes. Okay, here's how we could fix it. Let's revisit the philosophy, talk about purposing these assets, and here's some of my recommendations. If you don't get them to that mental hurdle, they're never going to move forward.
That's awesome. I love that. especially fixing problems. And that's what we talked about earlier at our get together in Pittsburgh about getting stalled deals off the ground. And that's exactly fixing the problem. It's, do you want to fix it? And how bad do you want to fix it? And that's what usually gets people off the chair and moving. As we wrap this thing today, I know we did cover a lot of ground. I love some of the takeaways. That's always good to learn from both of you, and you guys have been great sports today. I appreciate that. Anything else that we haven't talked about that you guys would like to bring in for everybody to learn from?
I'll just add too, because when we're talking about the now bucket, it may simply be the realization that they want to keep that money there. They just need to understand that the purpose of that is not to make money, right? So it's a two-way flow. It's not your flow. I think the big challenge that a lot of advisors have is we want to make their plan so much better, but that's not really how we're making it better. It might just be talking them off the ledge and saying, look, you have college you got to pay for. You're going to be doing this. You can do that. We don't want to risk this money. Return's not the purpose of this money. That's why we have it positioned here, right? We don't want that. We don't have the appetite for that volatility because that tuition bill is going to come. So a lot of times it's just that conversation. Yeah, you're right. I forgot about it. That's what it is. I'm not worried about making 6% on my non-bucket money anymore. So sometimes it's just re-educating what the purpose of the asset is.
And I mean, for anybody on the call today, and if you're listening on the pod, our support team, investment support team, is able to help you find those opportunities if you need them for the now bucket and those investments that might be beneficial to your clients, and if they're trying to get at least some return on that now bucket. There seems to be a pattern in the chat here. Charlie said something earlier, cash flow is the heartbeat of retirement. I love that. That's a good line, Charlie. Love that. What do you guys typically use from a now bucket perspective? How do you position that with your clients?
The thing I would close with is if somebody wants to buy CDs or anything like that, we have those options on our platforms. Don't let them buy them through their bank because you're just introducing trouble down the road because there's going to be other people that are going to be chirping in their ear all the time if they've got account numbers at other institutions. So you want to try to, gather as much of the money as possible to make the clients as sticky as possible.
And there are plenty of cash management options on our platform. Thanks, Charlie. That was a really good reminder. There are really good cash management options on the brokerage accounts that we have through Schwab and Fidelity that you can guys take advantage of. Yeah, Charlie's right. If you leave that money elsewhere, you may be inviting competition. And there's a lot of options that we can have on our platform that you can call us and get educated on that we can help with. And you can have control and monitor how that money flows in and out of the bucket plan.
To add to some great points that Greg made, what I've learned and what I've found is when I've narrowed down what their essential expenses and their discretionary expenses are, I find that now I have a target. All right. Once I have that target, their trust increases, and I tend to then control all phases of the bucket. Then their whole attitude is, what do I do next? What do I do next? So that's worked incredibly, but I think Greg laid some great foundational work and some of the points he made. So I just wanted to jump in real quick and just add that little thing, because they're always going to look back someday. And I always reinforce this question. I'll tell them if they ever seem confused, I say, look, someday the only thing you're going to care about is were you on pace to outlive your money or your money was going to outlive you. I said, that's what you're going to look back and care about. Is all right with you that I focus on that right now. And that really gets them dialed in and engaged. That's worked a lot in that case. So I hope that adds a little bit perspective to everyone as well.
Yeah, thanks, Frank. That was really good. All right. We're coming close to our half hour. Thanks to our two baristas for participating. And if there's anything that our support staff can do for you, please, by all means, reach out. We're here to help. Thank you for your business, and you have a wonderful rest of your week.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.